Welcome to Subramani. Please hit the bell icon. Please subscribe. One question which somebody has asked me, is it worth investing in REITs and INVITs in India? I'm going to split this question into many answers, so you may see many short answers. So, investing in REITs and infrastructure funds is definitely worthwhile for many investors, and particularly as a way to gain exposure to real estate. If you are a person like me who does not have any great real estate exposure other than the house in which you are living, you don't have any rental properties, this is a nice way to get entry into real estate in a small retail way, right? And normally you think that if interest yields, if rental yields in India are low, very unlikely that REITs can give good return. But I'll come to returns in a short while. But yes, it can be worthwhile for many investors, particularly as a way to get entry into real estate. And REIT pools funds to invest in income generating commercial estate. Commercial real estate entering is not easy for retail people, and especially for older people, right? You're not going to buy real estate, give it on rent, collect rent, and then that person saying, oh, now there is no there is water leaking and all that, because as a landlord it is your job to make sure that the house is in good condition, or he'll just stop paying rent, right? You don't want that to happen. So REIT pools funds to invest in income generating commercial real estate like office space, malls, warehouse, right? So while INVIT focus on infrastructure assets such as road, power plant, maybe airports, and warehouses, right? So transmission lines, so many of these things, more commercial oriented assets, but infrastructure oriented assets. These instruments offer diversification benefits. They are less correlated with traditional stocks. So if something is not good in the market and you're getting poor returns in equity, at that time this returns maybe 8, 10, 12%. Last year was something like 29% kind of return in one real estate REIT, right? So those kind of the things you can get. So India's REIT and INVIT markets have grown significantly, with assets crossing 9 lakh crores as on September 25 when I'm shooting this. These numbers are from the REIT organization, projected to reach 25 lakh crore by 2030, driven by regulatory support from SEBI and increasing investor awareness from 6,000 unit holders in 2019 to 5,40,000 in 2025. That's a fantastic growth rate, right? However, whether it is worth it depends on your own risk tolerance, investment horizon, portfolio goals. It's not ideal for everyone, especially if you're seeking high growth, speculative returns, bought on Monday, sold on Tuesday kind of a thing. But what it does, it creates steady income for you. So for a retired person who's dependent on annuity and bank deposits, REIT is not a bad option. Liquidity, it is traded. Unlike real estate, this is traded, so you can on BSE, NSE, so you can buy, sell more easily than physical assets. Diversification and accessibility, low entry barriers. You can enter with 10-15,000. This is still not come down to 500 rupees like equity funds, but it's a matter of time when that could also happen, right? Allowing retail investors to access premium assets. Transparency, it is regulated by SEBI, so there's a reasonable amount of safety. I'm not saying it is always going to be very safe, but yes, there is, because there's a regulator involved, unlike in say cryptocurrencies and things like that. So that way REIT is far safer. What are the negatives? Unit prices will fluctuate, but that is true for mutual funds. Anywhere that you put money, it will fluctuate, and in places like bank deposits, it will lose value to inflation. Growth on income rather than capital appreciation. So it's not so suitable for a 28-year-old wanting to put money, but it is very suitable for a 60-year-old who is retired, who doesn't have much other income, to put money in this and create income. Remember that 12 lakhs is the limit today for taxation. So if you don't have much of interest income and things like that, this is a good place from where to seek income. Tax inefficiencies, because dividends are taxable and there's no indexation benefit for capital gains. True for all assets, right? So it doesn't really matter. Sector specific issues, REIT tied to real estate demand, there could be a problem. There could be some real estate which is disputed. There could be some little lack of transparency between what a fund manager does and if he tries to make private profits. That is not going to happen in equity, but here it can happen. InVITs also same thing. Overall, a suitable balance can be found if you put 10 to 20% of your portfolio, not much more than that. Thank you.